Hello, this is Tim Congdon. I'm giving this presentation as Chairman of the Institute of International Monetary Research, but it's also relevant, I think, to subscribers of International Monetary Research Limited, of which I've been Chief Executive. Later on this week, it's late October, early November 2016, the Institute is holding a seminar in London on quantitative easing. And strictly the title is Quantitative Easing, Triumph or Folly? Question mark, of course. And we're going to discuss at that conference the implementation of quantitative easing programs from late 2008 in the main countries. My own presentation at the seminar will be on the question, why was QE necessary from late 2008? I'm going to start with a certain amount of theory, then I'll move very much on to the facts of the period, and I'm going to be making quite a strong allegation that official policy was, in the critical time, very badly handled, and it was the mistakes in policy that made QE necessary in late 2008 and early 2009. Economists have got different views about QE, and there are some people who claim that we don't really understand the subject. One of the people involved in drafting the papers behind the UK's implementation of the policy is Spencer Dale at the Bank of England at the time, who has said that the academic literature on the subject is in its infancy. There's somebody called Stephen Williamson, Vice President at the St. Louis Fed, who in the current issue of the Journal of Economic Literature, and again I quote, says the theory behind QE is not well developed. And we had Ben Bernanke, Chairman of the Federal Reserve, 2014 press conference, causing a lot of laughter by saying QE works in practice but doesn't work in theory. I regard all these statements as extraordinary. All that quantitative easing did was to increase the quantity of money. And the effects of that on the economy are determined, the result of can be interpreted in the context of traditional monetary theory going back a very long way. I don't want to get too much into nuts and bolts at this stage, but the heart of this theory is that people have a certain amount of money that they want to hold relative to their income and expenditure, in order, of course, that they can carry out their day-to-day expenditure plans, and also, of course, put aside a certain amount for saving, so that the amount of money they hold is related to income, related to their wealth. That statement is just the same as that we have a certain amount of food that we want to live our lives and so on, or a certain amount of housing services that we want. So there is a certain desired ratio of money to income and spending. And then when the actual quantity of money itself is given, obviously the desired ratio of money to income and the actual quantity of money then gives us the equilibrium level of national income and spending. It's as simple as that, reduced to its. So once we know what economists call the properties of a money demand function, of a relationship saying how much money we want to hold, once that's known, and once the quantity of money itself is known, then we can say what equilibrium national income is, and that's it. Now, this idea can be expressed in what's called the quantity theory. Money times the amount it turns around, velocity of circulation, is equal to the price level multiplied by the number of transactions. I don't want to dwell on that very much today, but it's a very long established theory. And one of the implications of this is that when the quantity of money changes by some X%, whether it be 2%, 5% or 50%, then the equilibrium level of income changes by the same X%, roughly speaking. In the real world, all sorts of complications and caveats and difficulties and provisos, fine, but roughly speaking that is correct. So national income also changes by 2%, 5%, 50%, roughly. And then to come back to QE, what QE did was to increase the quantity of money relative to what otherwise would have been, and therefore meant that national income was higher relative to what ours would have been by the same amount proportionally. Can I just at this point say that in this theory, such factors as credit spreads, financial confidence, the credit conditions, these things are not relevant to the story. And I'm afraid much of the popular media discussion of these topics has given far too much weight to these sort of variables, and in my view is little better than rather flimsy journalism, quite frankly. It's not proper theory, not proper analysis. The ideas I've just expressed have been around for about 500 years, since they were first discussed by a chap called Jean Baudin in France in the 16th century. On through a long tradition, Hume, a Frenchman called Cantillon in the 18th century, and then in the 19th century, John Stuart Mill, Wicksell, 20th century, Keynes, Friedman, Patinkin, many people have talked about these ideas. They are not in their infancy. They are very well developed. Okay. One of the implications of these ideas is that the state, the government, the central bank, perhaps a central bank by itself, whatever, has an obligation to keep the rate of growth of money fairly stable. Because if there is instability in the rate of growth of the quantity of money, there'll be wider macroeconomic instability. It also has an obligation to keep the rate of growth of money fairly low, similar to the rate of growth of national output, because that'll keep the price level stable and give us a good, sound currency. Now, let's just have a look at what happened in the period in the run-up to the Great Recession. And in the Great Recession itself and afterwards. You can see that the rate of growth of the quantity of money in 2006-2007 was 10% or above in the USA, the Eurozone and Britain. Now 10% and above is well above the rate of growth of national output. So there was the risk of rising inflation, and indeed it was a period of considerable buoyancy in asset prices. And the asset price movements often precede movements in the general price level. Okay. What you then see is that the rate of growth of the quantity of money collapsed in all three of these jurisdictions. I can't call them countries because the Eurozone isn't actually a country. The question obviously is then, why did the rate of money growth collapse? Now I've got to be a little bit technical. Nowadays, the principal form of money is bank deposits. We make most of our payments by instructions to our bank to move amounts between our account and another bank account to make the payment to that other person, or company, whatever it might be. So bank deposits are the principal form of money in a modern economy. And bank deposits are created by banks extending new credit to anyone. When a bank extends an overdraft to you or me, they add a certain sum to the asset side of the balance sheet, that's the new loan, and they add a deposit to the other side of the balance sheet, that's the deposit. Then we spend the deposit, it goes to another bank account, the money goes round and round and round, perhaps indefinitely. But it's the extension of the new credit that creates the money. Let's leave the international complication to one side for a moment. Then there are two main kinds of agent to whom banks can lend. They can lend to the private sector, which is risky, but it's usually profitable, or they can lend to the government. Now, in the 60 or so years up to 2007, the principal kind of credit extension by banks across the world had been to the private sector. After the Second World War, 1945, the banks had got lots of claims on governments. These weren't very profitable. It wasn't really helping the economy. So banks expanded by boosting their lending to the private sector, so that in 2006, early 2007, in many countries, including Britain, something like 95% of banks' assets were claims on the private sector. Risky claims on the private sector. What happened in the Great Recession was that this process stopped and went into reverse. And that is the main reason that money growth was collapsing in that I just showed you in this chart. That's the main reason that money growth collapsed. You can see this in this further chart, where I'm using data from the International Monetary Fund. The question then is, why did this money growth, why did this pattern of credit extension, why did it stop like this? Well, there were two shocks, in summary, to the world's banks, certainly the banks of the leading countries, in that period. The first was in August 2007, when it's called the global money market, the market in which banks themselves borrow and lend to each other, the interbank market, if you wish, closed to new borrowers. What this meant was that those banks that were big debtors to the interbank market, some of course are big creditors, those that were big debtors to the interbank market found they couldn't continue to expand, and indeed they, in some cases, had to shrink their assets in order to pay back the old loans that they'd had from other banks. This was a problem, and it was evidenced by the wider spreads in the interbank market to reflect worries about the creditworthiness of some of the banks, worries about whether or not these banks had enough capital. The second shock was in October 2008. I'll come back to the Lehman crisis at the end. In October 2008, the regulatory authorities across the world, America, Eurozone, Britain and elsewhere, met in the aftermath of the Lehman crisis to try and sort out what they thought was a long-standing systematic mess, and they forced banks to hold more capital relative to their risk assets, these claims on the private sector. How did the banks react? The banks reacted by reducing their risky assets, by reducing their loans to the private sector. That's what caused this collapse in the rate of growth of loans to the private sector. Indeed, as you can see, some of the loan books started to shrink, they actually went negative. If I repay my bank loan, I do so from a deposit. I have a deposit, okay? I use the bank some money, I use that deposit to repay the bank loan, they're both cancelled. The money disappears from the economy. Loan repayments imply destruction of money balances. Reduction of banks' risk assets means the quantity of money falls. That's why the quantity of money continued to fall after October 2008. What officialdom did in that period didn't make life easier for the world's economies, it made it worse. Now, you might at this point say, this is rather extraordinary. I mean, how could these people have done something so inappropriate and mistimed? And you might say, surely the really big problem was from August 2007. I'm going to show you in the next few minutes is that that's not true. What I've got here is some numbers which show the rate of growth of lending to the private sector in 4 periods. It's in the run-up to third quarter 2007, when the interbank market closed. Then the period of about 5 quarters from the middle of 2007 to autumn of 2008, when the same regulations, the same capital ratios applied to the World Banks as before. Then the 2 years from third quarter 2008, when the new regulations on capital and so on were taking effect, and then 5 years over after Q3 2008. And you can see that the reduction in the rate of growth of bank credit between the first period and the second period, the period when the interbank market was closed, was there, but not very profound, not very big. And indeed, in the middle of 2008, most people did not expect a big global recession to develop. They expected some trouble, but not what actually happened. And the IMF, the OECD, all these august bodies did not predict the Great Recession in its full intensity. They did not expect world output to fall as it did in 2009. There's always some complications, and there's some difficulties with some of the UK numbers because of something called intermediate other financial corporations. I won't bother you with that now. It remains true in all of these areas, all these jurisdictions, that the collapse in the growth rate of bank credit to the private sector was very pronounced only after the third quarter 2008, only after bank regulations had been tightened, only after officialdom had insisted banks had much more capital. And this is why QE became necessary in late 2008 and early 2009. What officialdom had done, by officialdom I mean the central bankers, the regulatory bodies, the governments and so on, under the aegis of the G20, you know, this anonymous group of 20 countries that nobody individually can be blamed, can they? This is what they decided to do, and this was about to cause the quantity of money to fall in the main countries by about 5 to 10% a year, as it had done in the USA in the Great Depression of the early 1930s. So the reason, the justification for QE was to offset the impact of this crazy decision. We need to remember that in that period, after the change in bank regulation, after demands for banks to have hold more capital, not only was QE implemented, but also the interest rates were slashed almost everywhere to zero, and they remain almost zero again in most of the main countries. What QE meant was that instead of the banks expanding their claims on the private sector, the banks expanded their claims on the state. You remember what I explained a few minutes ago, that banks can grow their balance sheets, they can grow their deposit liabilities, they can grow the quantity of money either by claims on the private sector or claims on the state. What QE meant was that the central banks usually went to the commercial banks, said, lend us some money, we'll, we the central bank, add to your cash reserves, and then the central banks then use the proceeds of this money from the commercial banks to go and buy assets on a vast scale from the financial institutions, from individuals to some extent, and that then increased the bank deposits of the financial institutions of the individuals, and then the bank deposits circulated around the economy and the economies recovered. But this would not have been necessary if there had not been this drastic change in bank regulation in October 2008 and then afterwards. I should say that the discussion I've just presented, the analysis I've given, is controversial. Well, Of course it is. But I would suggest that it is not plausible to attribute the global recession of 2009 to the Lehman Brothers bankruptcy. Lehman Brothers had two bits. There was the bit in the United States, there was the international bit. Lehman International repaid its creditors in full 100%, was okay. Lehman Brothers USA had a loss of about $150 billion. That's a tiny fraction of US output. Minuscule fraction of world output. How on earth can the problems of one medium-sized financial organization cause the calamity we saw in that period? Over and above that, I've just shown you those figures for the collapse in the growth rate of bank credit in such places as Australia and Sweden. Pray tell me, how is credit growth in Australia and Sweden affected by the Lehman Brothers bankruptcy, which is a very specifically American event? The decline in credit growth persisted for 5 years after the third quarter 2008, right through to the end of 2013, and it continues even today. How can that be due to Lehman Brothers bankruptcy? Happily, there was a big increase a big improvement in economic activity in Britain and elsewhere after the implementation of quantitative easing, and in my view, it was a very good thing that this occurred. But I'm afraid that we need to understand much better how money and banking interact with the economy. I said at the start that I thought Spencer Dale, Steve Williamson, Ben Bernanke indeed, were out of order when talking about the hats, when they said that we didn't understand the theory. We do really understand that theory. We need to remember traditional monetary theory so that the kind of thing we saw in late 2008 and early 2009 never happens again. Thank you.